Hey, what is up everyone? My name is the Smart Money Technician and welcome to today's YouTube video. So in today's video, we are going to be going through a day trading strategy that is very profitable and you can trade this every single week. Now, before I begin this video, I just need you to know that this is not a trading strategy that you are going to be trading every day, although it does happen every day across different assets. However, as professional traders, we are going to aim to trade only during the times that are high probability and only one asset. This way, we are able to control our risk and at the same time, we're still able to capture moves in the market. With that being said, the first thing that you need for this trading strategy is you need this indicator. It's called day quarterly theory. You go to indicators and you quickly search it, quarterly theory, and you select this one by 2 degrees and it will pop up on your chart. For this trading strategy, we are only going to use the daily quarters, or dare I say it, the daily cycle. For this trading strategy, we are going to view it through the lens of the M15 time frame. And with that being said, let's get into the video. Alright, so the way this trading strategy works is that we are going to look to trade during the New York session. And what we want to see is that the New York session will take out the low or the high, but in this example, the low of the London session in one asset in the indices, and in another indices you see that it fails to take out that low. This low is the lowest low in the London session, and we want to see that during the New York time we take out that low, whereby in another asset we want to see that we fail to take out the low of the London session. While this is taking place, because we are looking to buy, we want to see that price, while doing this, trades below the true day open, which is the midnight candle. Let's get into the charts and see how this looks. So as you can see, while we are on this chart, the first thing that we need to do before we enter into the New York session is that we want to mark out the high and the low of the previous session. In this case, this is going to be the London session. So over here, you can see that this red box is the London session, and we are going to mark out the highest high and the lowest low that is within the range of this red box representing the London session. The green box represents the New York session. We mark the low that is within this red box, that is our sell side liquidity or SSL, and then we mark out the high, which is our buy side liquidity or BSL. Now do the same for the other assets as well. Alright, now that we have the buy side liquidity and the sell side liquidity marked out on all three assets, what you want to do is you want to mark out the true open, which is at midnight. So this midnight candle is the true day open, which I delineate as TDO, representing true day open. Now what you want to see is that if we are looking to sell, we want to be above this price, and if we are looking to buy, we want to be below this price, the true day open. So let's play this out. We've entered into the New York session. We've traded very near to the low, but we have not yet touched the low on all three assets yet. As you can see over here, we did take out this high right here, but we didn't take it out over here. So that is an SMT divergence, and it does fit in the model of this trading system. However, for this particular setup, we are looking for a buy, as this trading model is combined with higher time frame analysis. So if you were bullish this day, you would be looking for a buy this day. This over here could have been seen as a scalp sell before the real buy takes place. So let's look at that. As you can see over here, we've tapped the sell side liquidity, but we have not tapped it here, and we have not tapped it here. So this is an SMT divergence. When you see this take place, what you want to do is you want to go one time frame lower to check if you see a breaker entry pattern. So I'm going to go to the M5, then I'm going to identify a low, a high, and a lower low, and I want to see price break through that and form a fair value gap. But in this case, we can see how far away price is in terms of this low to that high. This indicates to us that if this is going to be a breaker, this breaker is not going to be tagged to the M5, so we can go back to the M15 because this price action looks rather large. So this would be the breaker on M15. So price trades up through that breaker, and now we will wait for a fair value gap to form. Now that price forms a fair value gap, our entry will be on the breaker, and we can put the stop loss below the mean threshold of the breaker because this breaker is rather large and the fair value gap is above it. So we won't expect it to go too deep into the breaker, especially if price is very strong to the upside. So the entry is going to be on here, stop loss below the mean threshold, and the take profit is going to be a risk to reward of 1:3. The reason why we choose 1:3 is because even if we have a 30% win rate, we can still be profitable with that. However, I will say that this trading model has a higher winning percentage, so we just have to wait to get triggered into this trade. We are triggered into the trade. Once price trades above that high, you could put your stop to break even and watch to see if it reaches your target. As you can see over here, we have reached the target. Let's look for another setup. Alright, so we currently have another example, and the same thing we do is we mark out the high and the low of the previous session, which is the London session. Sell side liquidity, buy side liquidity, and the true day open, the opening price at midnight. We do that for the other assets as well. So guys, what we are doing is that we are marking the highest high and the lowest low of the London session, and we are watching to see if it gets taken out. So over here we can see that we have taken out the high of the London session right here, but we have not taken it out over here, so that should indicate that price could sell. However, the best time we want to see SMT take place is after 8:30. So if it happens very early in the session, it is generally not high probability. This is the reason why I ignored the first SMT that took place in the other example, and I'm also ignoring this one here as well. It doesn't mean you can't take this one, it just means that this one is not as high probability, and we want to trade one that is high probability. One that is high probability is one that happens after 8:30 during the New York session. Price sells off as expected, right? Because of that SMT, which you could have taken, but is not as high probability as we would like to see. So over here we can see that we've now taken out the low after 8:30. It is taking place during the ending of the New York session, which is fine, and we've also gone below the true day open, while over here we failed to take out the low of the London session, as you can see, right? So we failed to take out the low of the London session in the other assets, but we've taken it out in the Nasdaq. So when this takes place, you want to go one time frame lower and see if you have a breaker that forms. So over here you can see that we have taken out this lows right here, and then we broke above this level right here, making this area a breaker, right? So you would enter in at the fair value gap that is inside of the breaker, and your entry would be on the fair value gap and your stop loss below the breaker. However, we do see that there is a long wick over here, so as a caution we can just put it below the consequent encroachment, which is the midpoint of that long wick right here, in case price is very volatile and want to trade into a deeper premium. As usual, we will aim for a risk reward of 1:3, and we'll watch this play out. And just like that, you can see how the take profit gets hit. As you know, what we do first is we mark out the high and the low of the previous session, is the London session. So this red shaded area is the London session, the highest high within that session. And then we want to mark out the true day open, which is the opening price at midnight. All right, now that we have the buy side and sell side liquidity of our previous session marked out on all three charts, we are now going to watch and see if there is a setup. Remember, we want to see the setup take place after 8:30 for the highest probability. As you can see over here, we have taken out the sell side liquidity in Nasdaq and in S&P 500, but in Dow Jones we have not done that, but it is taking place ahead of the session. So this is generally low probability. However, you can be able to look for a reason to buy higher as it is taking place below the true day open. But like I said, we want the setup to take place after 8:30, so generally we will ignore this. The market starts buying here as we expect, and that is because of that SMT. As you can see over here in the Dow Jones and the S&P 500, they have reached very close to the high of the previous session, while Nasdaq is so far away. So we will expect Nasdaq to be the one to fail to get to that high. As you can see, the S&P 500 has also taken out the high of the previous session, while Nasdaq has not. So this is going to be the SMT divergence, and Nasdaq is going to be the one that makes the failure swing. What we are going to wait for is for a breaker to take place either on the M15 or one time frame lower, which is the M5. In this case, it looks like there is going to take place on the M5 just because there is no structure on the M15. So we will have to go to the M5 and see what happens. Now that we have traded above the true open of the day, and you can see we got very close to the high of the previous London session, but we didn't touch it, and we have broken down to the downside while forming a fair value gap. And you can see this high, low, higher high, and a breakdown, making this area a breaker. Like I said previously, you can see inside of here we have a long wick. Whenever you have a high that is a long wick, generally you don't want to put your stop loss above the high of the breaker because price may reach into a deeper premium into this wick. So your stop loss will go above the consequent encroachment, which is the midpoint of this wick right here. Entry on the fair value gap, stop loss above the consequent encroachment of the wick, and take profit 1:3. So let's see how this pans out. We want to see price trade into the fair value gap and reject around there. Price, we've just been triggered into the trade, and just like that our take profit gets hit. So This trading strategy is a very powerful trading strategy when done correctly. What you need to do is that you come into the market, you mark out the high and the low of the London session, and you watch on the other indices to see which one takes out the high and which one fails to take out the high, or which one takes out the low and which one fails to take out the low. And then you look for this setup to enter. This setup is your confirmation of the SMT that is taking place. With that being said, please like the video if you enjoyed the video, comment any questions you have, and subscribe for future content. Thank you.